mode.
So I hope we will get a chance to look at some interesting perspectives and some aspects of what happened so far this year. Again, I hope that everyone can listen to me clearly. If you have any questions, you can write them down, but I will try to answer questions at the end of the webinar so as not to interrupt the flow. So, having said that, let's begin. Here's a little outline of what we are going to do today. We're going to talk about the FX and various asset classes, their performance year to date, and then we will look at the major countries like the US and areas, the eurozone, Japan and the Bank of Japan, of course, the UK, Australia and China, and we will end up with commodities, crude oil and gold, and a summary going forward and some ideas. So as you're aware, the title of this presentation is Will the Dollar and the Stocks Bounce Back? Why did we say this? Because the dollar is down versus its major competitors. We have some trade disputes and political uncertainty, and maybe the previous rally in the dollar had priced in the Fed rate hikes. So we had definitely had some serious profit taking during 2018 on the dollar rally. Now, out of the various majors, the pound and the yen did very well. The pound, there were some positive developments about Brexit. There is also some expectation of rate hikes, and the yen, a relative safe haven and a country that has external surpluses, also doing well. Now, what is interesting is that the Aussie and the loonie did even worse than the US dollar because there were some worries about trade war, and there was some risk sentiment that was negative, and these currencies are very sensitive to such concerns. As you can see, the best performers are the pound against the dollar, up 3.6%. I mean, this would have been even larger if this chart was looked at about a week ago, but since we had some negative statistics about the pound, and it has limited its gains, and we are also seeing dollar yen being a serious loser. The other movements have not been so extreme. Euro Swiss franc has definitely been a winner. The euro has been gaining against the Swiss franc, roughly the gains that the euro has made versus US dollar. And you see the yen pairs are all red, so this means that the yen has gained. Now, what has happened with respect to stocks? They have recovered all or most of their losses for the year. US stocks are almost flat. Germany and the UK are still in the red, in the region of 2 to 4%. And volatility has made a comeback. We had very impressive gains during January at the start of 2018, then a very big sell-off, and then a comeback. So this has been quite a volatile first few months. We haven't seen this kind of volatility for a long time. And the other thing that I would like to note is that bond yields have been rising. And is there a level when bond yields are going to break the bull markets back? That is definitely something interesting. Now, we have to look at the various assets. Crude oil has been the best performer, it was a good opportunity to note that crude oil has done very well this year, up 13% year to date, and Brent crude up almost 11%. Now, on the opposite side, we have soft commodities losing 5.4%. 10-year treasuries, these are prices, not yields. So the price of the 10-year bonds are going down, the yields are going up. And we have the Japanese Nikkei. As the yen has strengthened, it has been and it hasn't been performing very well. And we have emerging equities not doing badly despite the rate hikes by the Fed, so that's another interesting point, and gold up by 2.5%, more or less matching the decline of the dollar index for gold, a bit better than the decline of the dollar index actually. Now, let's turn our attention to the US. The US economy has annualized growth of 2.9% in the fourth quarter. The overall 2017 growth rate is 2.3%. This is not spectacular growth, but it's okay. It should quicken this year because we had the tax cuts which could kick in and some momentum generally in the US economy. We have very key figures, first quarter growth coming out on Friday, so that should be very interesting to watch. Headline inflation surged to 2.4% in March. Core inflation a little bit less at 2.1%. And the core PCE price index, because the Fed concentrates on the PCE price index, not the CPI or consumer price inflation, which is what most economists could look at. So the core PCE price index is at 1.6% in February. The Fed's target is 2%, so it's going to rise to around 1.9% this year. Should be interesting to watch. Unemployment at a 17-year low, that is very impressive, at 4.1%, very low unemployment. And we have hourly earnings, they are rising by, their increase has dropped back to 2.7%. It was 2.9% in January. So you want to see that going up. That is going to help the US consumer. So the big question is, are all the fundamentals that we have talked about here, are they going to push inflation higher in the US, and why do we care about that? That will in turn push the Fed to hike rates more. So you see the orange line is the PCE price index, core PCE, and the more volatile consumer price inflation. So the core PCE has been more stable, and this is what the Fed is watching. And this is the employment market, the labor market. These are surveys of business confidence. They are looking quite healthy at around 59, between 58 and 60. That is indicating healthy expansion for both services and manufacturing in the United States. Now, we have the trade standoff and the threat of US tariffs, mainly against China by President Trump. But because you see Trump announces tariffs but then gives a lot of exceptions to US allies, so that pretty much leaves few countries that are with big economic weight that are facing these sanctions, these tariffs, and one of them is China. So we have this negotiation going on. However, if this is posturing, or in another word, in poker terms, bluffing, could this escalate out of control and lead to a trade war? Domestically also, Trump has his issue. The Mueller probe is heating up. The Trump lawyer has been raided during the past few days. Geopolitics, we did have this worry that there was going to be there was tension between US and Russia ahead of the strikes in Syria, but now this situation is not so tense and is not looking likely to escalate. And also the news is that we have progress on the North Korean front, so maybe there will be positive developments there as well. And we should also note that we have the midterm elections next in November, and those could be key if Trump loses his majority, particularly in the House of Representatives. It could be extremely difficult for him to get legislation through. So that's another thing to watch for the US. The Federal Reserve, with its new president pictured here, Jerome Powell, it lifted rates in March to 1.5 to 1.75%, so it gives a band for this. We are expecting 2 more increases for 2018, but if this forecast is wrong, it's probably going to be because there will be 3 indices. So it's asymmetric, if you like, because it's more probable to get more increases than 2 rather than less increases than 2. Such a revision could well take place if inflation and growth accelerate, and we could see an upgrade of the dot plot as early as June. Now, we also have a new vice chair. It has been nominated. Richard Clarida has been nominated for the post. So the key risk would be, I think, trade tensions. This is something that is worth watching, and this could impact business investments. Already we are seeing some impact in the US economy from this threat of trade measures. Here you can see, what are we seeing here? We are seeing the bond yields or the long-term interest rates in the United States. We start with the orange line, it's the 2-year rate. This is more accurately reflecting the expectations for future monetary policy. So you start with 2013. If you bought 2-year paper, you were only getting 0.25% or so. Now you are almost getting 2.5%. So there's a very big increase in long-term interest rates. With 10-year bonds, we did have almost 3% interest rates back in 2013 and late 2013 again. This was the time of the taper tantrum, and we had an increase in treasury yields, but they backed down to below 2% after the taper tantrum. And the Fed was going to be very gradual in stopping QE. And here is 5 years. So if this 3% level is breached in 10-year treasuries, it could be something important. Here you see the dollar index. This is the beginning of the year. It has fallen, but I would say that this is more or less stable. The dollar index, trade-weighted index with 6 major currencies against the US dollar. On to the Eurozone. Eurozone growth came in at 2.7% year-on-year in the fourth quarter. This is the highest since 2011, so it's the highest growth rate in 6 years. But headline inflation is not rising so rapidly because core inflation is around 1% in March. It really takes some pushing to go to 2%. So inflation is a bit of an issue for those that are expecting the ECB to remove stimulus. The unemployment rate is low by European standards. We mentioned the US unemployment is 4.1%. Now, eurozone is 8.5%, but a lot of structural and long-term unemployment and not as flexible, the eurozone labor markets. We are seeing some slowdown in the eurozone economic expansion. We had some slightly disappointing manufacturing PMI today. So it's looking that we have a deceleration in growth for the eurozone. Here you see the composite PMI slowing down a little bit from its peak early in the year. GDP was very healthy, and here you see inflation. The ECB's mandate is to keep it below 2%, but close. Well, this is not rising maybe fast enough to challenge this 2% target. Now, what is the ECB up to these days? It's still buying government bonds and some corporate bonds. It's buying around 30 billion per month from 60 billion euros pace last year. This is going to run until September of 2018 at the least. So maybe it's going to continue the purchases, but we'll see. Maybe I think that there will be more reduction. We should expect more reduction by the end of the year. Forward guidance for rates. Well, they're not exactly forecasting any rate hikes anytime soon. Maybe next year, according to the market. Maybe we'll stop having negative interest rates from the ECB. And there's quite a debate within the ECB, of course, that some on the Board of Governors, some want an end date to QE, others don't want a premature tightening. And we said maybe QE is going to end by year end, and rates should start to rise by mid-2019. And the next monetary policy is in a few days on Thursday, so all eyes on that. Political risks. You hear a lot about political risks in the Eurozone, but nothing very earth-shattering has happened. Angela Merkel has survived in Germany. She's put together a grand coalition with the Social Democrats. Catalan independence stories no longer making headlines. Markets complacent about that. Italy is a risk. We had inconclusive elections, but also the market's not too worried about Italy. Of course, we have Brexit, what's going to happen there, as well as trade risks. The EU is exempted for US tariffs, but Trump is unhappy about the German surplus, and he has made some threatening noises about the German cars. Here you see euro dollar. It has been rising. This is more or less a positive picture, but I would say that since the start of the year we have been in this 121.60 to 125.40 range, so pretty much range bound. The main tendency, of course, is bullish, as you see from the chart, but it is in this consolidation, let's say. On to Japan. Good growth, 2.5%, 1.6% annually in fourth quarter. We have good exports in Japan helping the economy, but as I mentioned earlier, we had the rise in the yen. The yen rose against all its major competitors, so this is hurting export growth. Inflation is also very slow in Japan. 1% in February was the highest since March 2015, but it has since is back to 0.9%. So the 2% target is very hopeful indeed that the Bank of Japan is going to meet. The unemployment rate, one of the lowest unemployment rates in the world at 2.4%, now at 2.5%, but wages are not going up, inflation is not going up. Here you see in the green line, this is the export growth, so we have deceleration in exports and it could hurt the economy a little bit. Household spending, not really very exciting. Inflation, yes, we are having a positive trend, but very far from the 2% level. Now, Bank of Japan is not near the stimulus exit door. Inflation is low. We looked at it in the previous picture, near below 1%. In March, the Governor Kuroda said we would start considering normalization, Bank of Japan, that is, if inflation reaches 2%. If we are expecting inflation to reach to the 2% target, this has been something we have heard again and again throughout the years. Wage growth has shown signs of picking up lately, but still very low overall. Wage growth is very key because it's going to push up consumption, and consumption may turn into higher inflation. So no Bank of Japan policy change is expected. Now dollar yen, we have seen a rally in dollar yen since around late March. We have seen a substantial rebound, but I would caution and say that it's still in a downtrend. So maybe one can say that this has been a correction of a bearish trend, and we need definitely more upside to reverse this picture. By the way, I will answer all your questions towards the end. Just one note, quantitative easing, for those of you who don't know, is printing money to buy government bonds. So once you run out of interest rate room, if interest rates get to zero, the central banks still want to stimulate the economy. They print money to buy bonds, usually government bonds. UK economy has slowed down a little bit, but inflation very high in the UK. A 6-year high of 3.1% in November. It has come in quite a bit to 2.5%. So we are seeing a deceleration in inflation. The Bank of England's target is 2%, so this might justify some rate hikes in the UK. February's wage growth came in less than expected last month. Average weekly earnings are growing by around 2.8%. This is good because it's bigger than inflation, but it's not something that is going to push for aggressive rate hikes. It doesn't mean that we have a situation where much higher interest rates are called for. We also had some deceleration in business service. So a slight slowdown, although growth is continuing. Retail sales have slowed down quite a bit. There was a big pickup right after the Brexit referendum. Now they are much slower. Average hourly earnings, they are holding up well, and inflation is touched 3%, but now it's around 2.1%. Now, GDP, we said it's showing a good trend, but manufacturing output also doing fairly well. UK manufacturing output is still positive. We'll see whether the stronger pound is going to hurt that. A lot of attention on Brexit. Of course, we had a transition deal between the UK and the EU in March, which stated that it's going to have a 21-month period, which after the deadline on March 29, 2019, we will have this transition period. So this reduces the uncertainty for businesses. Now, two factors maybe are helping sterling. We said it performed very well. Speculation about the rate hike. This has died down a little bit, and also that things are going well in the EU and UK negotiations. Still, I would note the negotiations are far from over. We still haven't learned about what the future trade relationship is going to be, what is going to happen to the Northern Ireland, the Irish border issue, and what is going to happen to the rights of EU citizens living in the UK after their departure. And we have these developments going on in the UK with the pro-EU camp and the pro-Brexit camp trying to score victories in terms of and trying to determine how the final outcome of the negotiations is going to be. Now, the Bank of England raised rates back in November. However, the expectations for a May rate hike were proved wrong. We had the weak data last week. We had a big sell-off in sterling, and Governor Carney said more or less it doesn't have to be May that the rate hike is going to take place. The outlook for inflation as well as wage growth and the Brexit talks are very key for determining monetary policy. And here is the pound. Again, we see the pound is in an uptrend, but we have suffered through a severe correction in the past during the past week because of the weak data and because of Governor Carney's intervention for concerning the May rate hike. So an uptrend, but quite a volatile pair also, pound dollar. Euro pound, maybe you get a better idea because the euro hasn't been the weakling this year. It has done relatively okay versus the dollar, but here again the pound has managed to do well. It's trading below the 200-day moving average. On to Australia, we have a slowdown in fourth quarter growth. So it has moderated, the annual rate has moderated, and now it's expected to reach 2.8% in 2018. The problem with Australia is high household debt is the problem. So the RBA, the Reserve Bank of Australia, has to be very careful when it's raising interest rates because a lot of people have a lot of debt in Australia, a lot of households. Annual inflation, well, it hasn't really crossed into the target band of 2 to 3%, so it's below the target band. So no worries from there. Labor market has strengthened significantly, not during 2017, not so good right now. Unemployment is around 5.5%. And also, Australia is very sensitive to commodity prices. It's exporting a lot of industrial metals. And if there is going to be a trade war, Australia could be hit a lot, even if it is a US ally, because it is its main main customer is China, so if China is impacted, then Australia will also be impacted. Of course, there is another theory that maybe China could substitute US imports with Australian ones, but that is a little bit doubtful as China is selling a lot of manufactured goods, Australia a lot of raw materials. RBA has kept the rates at a record low of 1.5%, is not looking to raise those rates soon, and the RBA expects only gradual progress in higher inflation because wages are not rising so fast. Again, we see a persistent pattern, by the way, for the other economies that we talked about, that wages are not really rising by a lot, and this is keeping inflation low. So this is something, maybe the most acute acute problem is faced by Japan, but the others are also facing this problem. The RBA is also keeping an eye on the exchange rate, and it's keeping it doesn't want the Aussie to rise so much. So that is something that it's definitely keeping an eye on the exchange rate. It's one of the central banks that is very vocal about exchange rates, the RBA. You see here with the orange bars growth, we have some deceleration from the very high growth of the second quarter of 2017. Inflation below 2%, the blue line is still below 2%. And the unemployment rate, here it's around 5.5%. Employed persons, generally okay, the labor market, but some weakness, some deceleration in 2018. For the Aussie, the technical picture of the Aussie maybe is not the most clear. We have had a big drop against the dollar since mid-January this year. However, I would like to note that overall there is a slight uptrend in the Australian dollar, especially on a weekly chart. So that is interesting to note that it has been significant. Yes, it has been big, but maybe longer term this is going to prove just a correction. We will see. On to China. Good growth of around 6.8%. No real inflation problems. Also, inflation is 2.1% in March. Producer prices, which can be a leading indicator of inflation, are also have also decelerated quite a bit. Now, the People's Bank of China rate was unchanged. It has been steady for the past 3 years, almost 3 years now. We have been seeing short-term rates rise a little bit in order to prevent the capital outflows. Of course, the yuan hit a 2.5-year high versus the US dollar. The US is unhappy about China's exchange rate policy, but we should also note that the US dollar has been falling against most currencies this year, so maybe it's natural to expect a weakness against the yuan also. What is the risk in China? Well, obviously the threat of a trade war is pretty big because it has a large trade surplus with the US. And the Trump administration wants China to come up with a plan to reduce it by 100 billion. The Chinese president has pledged some reforms to make China more open to foreign companies, to lift some of the restrictions, and also to help to boost imports from the US. We are having talks between the two sides. But we did get some jitters because we had the ban on American companies supplying components to the Chinese telecom giant. This hurt Chinese tech stocks. It's very difficult maybe for Chinese tech companies also to buy US companies. And the Chinese stock market has suffered as a result. One issue that we should focus on also in China is the deleverage of the economy. Again, is another country with a huge debt, and we need to see it coming down in an orderly fashion and to prevent any kind of credit crisis there. PMI in a blue line, it's above the 50 line comfortably since mid-2016. So shows that the manufacturing sector in China is doing well. PPI, which is producer prices, which are wholesale prices, have decelerated quite a bit from a peak of around 8%. Now they are about 3%. And GDP holding on in the 6.5% to 7% annual range. This is a chart of the yuan. Lower number means that the yuan is getting stronger. On to our best performer, which has been crude oil. Oil prices rallied. WTI, the US benchmark, is up by around 13%. Brent is up by more than 10%. What has driven the latest increase in oil prices? Well, the threat of fresh sanctions on Iran, for sure. Speculation that OPEC and non-OPEC cuts are going to continue, and this has helped to rebalance the market. At the same time, we have expanding US production, so a rising oil price is not a sure bet, not at all, because higher prices are also encouraging more producers in the US to take on projects that were previously uneconomic. So we will see in May whether the US is going to indeed impose new sanctions on Iran, and of course we have to see what the reaction of US producers is to higher prices. It's interesting to note here that the March 29 forecast of oil analyst by Reuters is showing a little bit lower oil prices than what is currently in the market. So this is Saudi production, this is Russian production. These are the oil prices. And this is very interesting that now United States has almost surpassed Russia in terms of production, has surpassed Saudi Arabia, and so you see this very big increase from around 7.1 million barrels per day to 10.5 million barrels per day. Very interesting increase in US production because of shale oil. Gold has done okay, but nothing too spectacular, up 2.5% year to date. When you consider that the dollar index is down around 2%, this is more or less mimicking the close to the dollar index's losses, reverse picture if you like. Protectionism, concerns about the trade war and geopolitics have pushed prices up, but the geopolitical risks, especially Syria and North Korea, are fading. The dollar has also stabilized. Trade tensions are definitely a near-term driver. US political uncertainty, and I would add to this, of course, the rise in long-term interest rates in the US. Higher interest rates make it less affordable to hold gold because gold does not does not yield any interest. So it's much better to hold the interest-bearing assets. And if the interest rates are high, then it makes it makes less sense to own gold. Gold has been between 1307 and 1366 for the past period. 1375 is the crucial test for gold. If it breaks through that, it's going to go to a fresh 5-year high. So let's see about the summary. The US dollar is not doing well. Fed hikes might have been priced in previously, and we have the added concern about trade war worries and some about political uncertainty. The euro's momentum has also weakened, together with the economic momentum of the eurozone, which casts doubt on when exactly the ECB is going to withdraw stimulus. It's going to happen, but with every piece of, let's say, not so great economic news out of the eurozone, there are worries that the ECB is going to be more patient and this could hurt the euro. The yen hasn't been so weak despite no end in sight for Japanese money printing or quantitative easing. It does have safe haven appeal and some external surpluses, so Japan's still a net exporter. The pound is stronger, definitely, but it's a very volatile currency. The rally feels overdone for now, so corrections can be sharp, as the correction that we have seen over the past week. The Aussie, the Loonie, and the Kiwi, so the Australian, Canadian, and New Zealand dollars, they are commodity currencies. They are underpinned by global growth prospects, but trade or risk-off worries can depress them. Now, stocks are struggling to reassert the bull market. They have to make new highs to show that they are in a new bull phase. Bond yields or bond interest rates are in an uptrend and near key levels. This could be important. We talked about the 3% level for treasury bonds. And commodities, we have global growth, but there are worries about trade frictions. At the same time, uncertainty about geopolitics, about trade wars, can support safe havens such as gold, which is a commodity, of course. Now, let's see what happened since we talked back in January. We said that the US dollar's picture was pretty negative, so we should just let the US dollar fall more. We were a little bit more optimistic on the euro. It has been stable. It has gained against the US dollar, but nothing so dramatic. The pound broke out, really posted a substantial rally, and the yen gained on turbulence in the stock market. So it gained from its safe haven characteristics. Going forward, it's not impossible that the US dollar has bottomed, and it could be supported by higher yields going forward. However, we also need to check that the technicals need to align. If there is a rally in the US dollar, it's not going to be only because of positive developments in the US, but if the euro starts to look a little bit weaker, the yen is also looking a bit weaker, or the pound, that could give the ground for the dollar to gain some ground, because it's going to, as a lot of people have said, it's going to be the cleanest shirt in the laundry basket. So it's not going to be a very exciting opportunity, but the fact that, you have this story by higher interest rate, it could help the US dollar. The euro, I think for now has stopped being as hot because if there is some deceleration in the eurozone economy, I don't know how quickly the ECB is going to curtail stimulus, and if we continue to see a slowdown, then the euro could get hurt because the ECB is going to sit on the fence for longer with this kind of stimulus policies. This could hurt, although not dramatically. I think that for now the euro has stopped being as hot, but it doesn't mean that it's going to reverse its trend, I think. Now, the pound, we have had some impressive gains, but also very sharp pullbacks. So has it gone from the market's favorite short post-Brexit to the market's darling right now? It's very interesting because maybe some of the gains have been overdone, but very strong technical picture on the pound, I repeat, so we should pay attention to the technicals. Now, for the yen technical picture is also looking very strong. However, if the markets stay calm and we have a positive risk sentiment, maybe that's a big if, because maybe if there's volatility, it's going to benefit the yen. But if we have some calm, then Bank of Japan stimulus in the form of money printing is eventually going to catch up with the yen, I believe. And strong yen is also anathema to the Japanese government, which has had its share of problems, I might add. We did see a scandal recently. So any questions, please feel free to write them. And I would also like to point out that anybody who wants a copy of today's presentation in PDF format, please let me know in the questions, and I will make sure that you get a PDF copy of the presentation. Please feel free to visit our website. Here you will find a lot of interesting news. You will find the market previews, which are going to set you up for the trading day. We have a European Open preview and a US Open preview. You will get lots of technical analysis, so you can go and we are posting quite a lot of technical analysis. We try to explain what is happening to each instrument, and we actually try to explain what is taking place rather than just give you some symbols or we try to explain in plain English what is happening. Our special reports, our forex previews are previews of market moving events or data, so those are also interesting, and also about the stock market, commodities, indices, and the videos that we have both daily and on a weekly basis. Subscribe to our YouTube channel, and thank you very much. Now, I will of course send a PDF to your to all those that very good question is how do yields affect currencies? Well, think about it this way. Yields are just maybe a fancy term for interest rates. Okay, this is a return on a bond, on an instrument. So if we have high interest rate, then this tends to benefit the currency, just as long as the high interest rate is not a sign that the currency is in trouble. Because if this is a sign of the currency being in trouble, then this can actually mean a loss of confidence for investors. Well, if gold earns no interest, then you can and it doesn't really matter if you hold physical gold or CFDs. If you hold physical gold, you have to store it, you have to keep it safe, so it has a negative cost instead of money in the bank. In theory, should give you some interest. Questions about the yuan on your trading platform, I think you should address them to your account representatives. And a question about South Africa. I think that the South African rand has done fairly relatively well this year. It has been one of the better performers. We had this political news, and we had definitely it was a positive. There were some positive developments there. Rate hikes make currencies stronger, not weaker. So, because we said that higher interest rates are benefiting currencies. What does it mean that if the unemployment is very low and wages are not going up as fast? It could mean that there is still extra slack in the economy, and there could be many reasons for wages staying low. There could be structural reasons, so it's not a sign. It's not necessarily a sign that something wrong is with the economy. Something wrong with the economy. Now, dollar yen to be considered a reversal uptrend. I will have a look. Let's see the dollar yen chart. I want to check particularly the 200-day moving average. Well, here it looks around 110 would be a good level to say that there has been some reversal. For now, the market is eyeing the 108, 108.5. So this is psychologically important level. It's above the 50-day moving average, and the confirmation of that reversal, of course, we would have if the 50-day moving average crosses above the 200-day. So this would be a confirmation that we have a reversal in the trend, and obviously we need to take out finally we need to take out these highs over here. If an interest rate is going up because of higher inflation, this could be detrimental to a currency strength, especially if interest rate is lower than inflation. So if you have inflation at around 15% in a country and the interest rate is 10%, let's say, this is not such a good sign for the currency. So you need real interest rates to be going higher as well. The correlation between European stocks and US stocks, very positive. It's impossible, I think, for European stocks to make substantial headway unless the eurozone stocks are also going up. So, in general, stocks around the world follow the global sentiment. They follow especially the US market, which is very key in shaping global sentiment. But of course, each country is going to perform differently. Doesn't mean that they perform the same. Some countries are going to perform very well in years that maybe the US stock market goes up by 10%, maybe some other country is going to go up by 20-25%, another is going to go up by a couple of percent. So why does President Trump is declaring a trade war with China? Well, basically, a tougher policy against China was one of the campaign promises of President Trump. He thinks that the Chinese have taken advantage of the US, that it hasn't been a fair system, and this is why he's doing what he is. At the same time, we're not sure that this is if the threat is real or not, because a trade war would be seriously detrimental to both countries. So for now, I think the markets are a little bit complacent, and they think that there is little chance of a trade war, and that most of it is, let's say, a game that is aimed to achieve a better negotiated deal. So we'll see whether the markets are right or not in saying this. Okay, I think we have answered most of the questions. Just 1 second. Question about US LIBOR. Well, we said about the 10-year Treasury note, if the yield crosses 3%, then this could be a very important sign that bond yields are very high, are getting higher. So this could actually be a game changer. We will see whether that is indeed the case. If we go above 3%, of course, but it's looking very likely that we will. By trading currencies when the markets overlap, it's the most liquid time of the day, so you get the best liquidity. Also, you get the most action, but if you are getting also some big moves, you could get them right, or you could also get them wrong. So you should also pay attention to your money management and risk management when you are trading at hours when volatility in the market can be high. Fundamental analysis is, I would also agree that it plays a little bit more important role in stock market trading, although it's important for both. I think fundamental analysis is important for both, but currency pairs can spend years in misalignment. So fundamentals would tell you that there is a misalignment, but would tell you very little about the time when that misalignment is going to occur. Okay, one final question is about fear and trading. This is not really our topic about trading, so you should direct them to your instructors that are to webinars that are more specialized about psychology in trading. But I think the best way to manage fear is also to manage your risk. And if you have a good risk management framework and you know that how much you are staking on every single trade and you make that decision before you open the trade, I think then you don't have as much fear. So thank you very, very much for joining us today. Thank you for being here. I hope you found this presentation interesting, that I managed uh, to show some interesting perspectives and share some interesting thoughts that are going to help you. And hopefully we will be back in around 3 months to look at what has happened from now. During the second quarter, the markets are looking quite exciting. There is quite a bit of volatility, so we're hoping to have some interesting time in the markets and some interesting opportunities for you. Okay, thank you again and have a great day.